There are two investors inside every person who has ever seriously participated in the financial markets. The first investor is the one who shows up at the beginning, young or old. It does not matter. They show up with energy and enthusiasm and a hunger to understand how wealth is built and a belief that the right information, the right strategy, the right insight will unlock something that has been locked away from them until now. They read voraciously. They watch the prices. They study the patterns. They feel the excitement of participating in something vast and consequential. They make their first decisions with a mixture of logic and hope, and they wait to see what the market says about those decisions. And the market says something. Sometimes it says you were right. Sometimes it says you were wrong. And what happens next, in response to what the market says, is what determines whether the first investor ever becomes the second. The second investor is the one who survives, not just financially, although financial survival matters enormously. The second investor survives psychologically. They have been through enough market cycles, enough personal financial crises, enough moments where everything they believed about their own judgment was tested by reality, that they have built something the first investor does not yet have. They have built a relationship with uncertainty that does not require resolution to function. They have built the ability to hold a position they know is correct, while the market spends months telling them they are wrong. They have built the discipline of the written process over the impulse of the felt emotion, and they have built the humility to know exactly what they do not know, and the confidence to act decisively within the boundaries of what they do. Today, I want to tell you the story of those two investors. My story not as a record of achievement, but as a map of the specific transformations that turned the first investor into the second. Because if you are currently the first investor, the map is what you need most. And if you believe you are already the second investor, the map may show you that there is still distance to travel, who the first investor was. Let me be specific about the first investor I was, because specificity is more useful than generality. When I arrived on Wall Street in 1914, I was genuinely skilled at certain things. I was analytically gifted. I could look at a set of financial statements and extract meaning that many of my contemporaries missed. I could hold complex calculations in my head. I could identify patterns in financial data that were not immediately obvious to less numerically inclined readers. And these skills were real, and they were valuable, and they contributed genuinely to the results I produced in those early years. But alongside those real skills, I carried a set of beliefs about myself and about markets that were far more dangerous than any analytical weakness could have been. The first belief was that skill was sufficient protection. I believed that if my analysis was correct, I was protected, that the quality of the reasoning that led me into a position would protect the position from serious harm. What I had not yet understood was that correct analysis and structural soundness are completely separate things, and that one does not provide protection against the failure of the other. A correct analysis inside a fragile structure is still fragile. And when the structure breaks, the quality of the analysis becomes irrelevant. The second belief was that I understood the market better than the market understood itself. This is perhaps the most common and most dangerous belief that the first investor carries. I had been right enough times in a row that I had developed a model of myself as someone whose judgment reliably exceeded the collective judgment of the market. This model was partially true in specific analytical domains. It was catastrophically untrue as a general proposition about market dynamics. The market is not a single entity whose judgment can be exceeded. It is the aggregated behavior of millions of human beings, each carrying their own fears and hopes and constraints and time horizons, and none of whom are obligated to agree with my analysis on any timeline that is useful to me. The market is not wrong when it disagrees with me. The market is simply doing what markets do. And the first investor I was had not yet understood the difference between being analytically correct and being operationally right in a market that does not care about my analysis until it decides. To the third belief was that confidence and conviction were the same thing. I felt confident about positions I had not fully stress-tested. I confused the feeling of certainty that comes from having done careful analysis with the different and much rarer thing that is genuine conviction that survives testing. Genuine conviction is what remains after you have honestly tried to break your own thesis. It is what remains after you have looked at the best bear case for the investment you are about to make and found that the bear case does not change your conclusion. Confidence without that stress testing is just a feeling, and feelings are not protection against markets that have no interest in accommodating them. These three beliefs, the sufficiency of skill, the superiority of my judgment, and the conflation of confidence with conviction, were what the first investor I was carried into every decision, and they were what made October 1929 as damaging as it turned out to be. Not the analysis, the beliefs. The first transformation. The transformation from the first investor to the second does not happen in a single moment. I want to be clear about this because the narrative of transformation in finance tends toward the dramatic. The single insight that changed everything. The one book that rewired the brain. The one loss that produced the permanent lesson. My experience was different. The transformation happened slowly and then all at once. And the slow part took years and involved dozens of smaller adjustments that felt at the time like isolated corrections rather than the pieces of a coherent new framework. But there was a first transformation, and it happened after 1929. It happened in the months of quiet work that followed the floor I described in the previous video. The first transformation was learning to separate what I could control from what I could not. Before 1929, I had been trying to control outcomes. I had been trying to be right about what the market would do and when it would recognize the value I had identified after 1929. I understood that I could not control outcomes. I could only control inputs, the quality of the analysis, the soundness of the structure, the patience of the execution, the honesty of the ongoing assessment, and the discipline to follow the process, even when the short-term outcome was contradicting it. This sounds simple. When I describe it now, it was genuinely difficult to internalize at the time because the first investor in me had been measuring himself by outcomes, right? Call, wrong call, profitable position, losing position, and shifting to measuring myself by the quality of the process rather than the quality of the immediate result required a fundamental change in what I considered success. The day I made a good decision that produced a bad outcome and was able to look at it clearly and say the process was right and the outcome was not my responsibility to control was the day the first transformation was complete, and from that day forward, the daily anxiety of investing diminished dramatically. Not because the outcomes improved immediately, but because I had stopped making the outcomes. The measure of my competence, the second transformation, took longer and arrived more gradually. It was the transformation from knowing the principles to living them. This is a distinction that most investors underestimate because the gap between knowing and living is invisible until the moment of pressure arrives. I knew about the margin of safety before 1929. I had developed the concept. I had written about it. I had taught it in various forms to students and colleagues. But in 1929, when the analysis told me the positions were sound and the margin was sufficient and the underlying values were real, I had not built the margin of safety deeply enough into the structure. I knew the principle. I had not lived it at the level the principle required. The second transformation was learning to apply the principles not to the version of the world where everything goes as expected, but to the version of the world where everything goes wrong. Simultaneously, the margin of safety is not the gap between my estimate of intrinsic value and the current price that is the arithmetic of the margin of safety. The living of the margin of safety is the question I ask before every position. What happens to this investment and to my ability to hold this investment if I am wrong about the analysis and the market is also wrong about the price in the same direction at the same time? Asking that question changes the answer significantly. It changes the position size. It changes the structural requirements around the position. It changes the patience required before the position becomes justified, and it changes the emotional relationship with the position once it is established. Because you have already stress-tested it against the worst case and found that the worst case is survivable, living the margin of safety, rather than knowing it is the difference between the investor who says they will hold through volatility and the investor who actually holds one of them prepared for the volatility before it arrived. The other is meeting it for the first time when they can least afford to the third transformation. The third transformation was the most unexpected, and in some ways the most important. It was learning that I did not need to have an opinion about most things. The first investor in me had felt pressure to have a view on every stock, on every sector, on every macroeconomic development, on every geopolitical event that might affect market prices. This pressure came from the environment of Wall Street, where having a view on everything was a form of professional credibility. The analyst who said, "I do not know enough about that to have a useful opinion," was seen as less competent than the analyst who offered a confident view on anything asked of them, but the confident views on things outside. My genuine competence were noise. They were not contributing to better decisions. They were contributing to activity. And activity is the enemy of the kind of patient compounding that produces serious wealth over long periods. The third transformation was learning to say, "I do not know," with the same confidence that I brought to the things I genuinely did know. The circle of competence is not a limitation, it is a clarification. It says, here are the domains where my knowledge is deep enough that my judgment adds genuine value, and everything outside those domains is territory, where someone with deeper knowledge will consistently outperform me, and where my activity is more likely to produce harm than good. The investor who can honestly map their circle of competence and then ruthlessly restrict their activity to within that circle makes dramatically fewer decisions than the average market participant, and the decisions they make within the circle are dramatically better than the decisions they would make outside. It's shrinking my universe of investable ideas was one of the most counterintuitive and most valuable decisions of my investment career. It felt like giving up. It was actually the opposite. It was concentrating my analytical effort on the territory where my effort produced genuine returns, instead of spreading it across a territory so wide that the effort was diluted into uselessness. The fourth transformation was learning to be wrong with equanimity. The first investor in me had treated being wrong as a threat, not primarily a financial threat, though the financial cost mattered, a psychological threat. An investment that did not work was a data point against the thesis that my judgment was reliable and my analytical methods were sound, and defending that thesis sometimes led me to hold positions longer than the analysis justified, or to find reasons why the current market price was wrong, rather than reasons why my original analysis might need revision. The second investor learned to treat being wrong as information about the limits of the analytical framework, information about the assumptions I had been making that the evidence did not support, information about what I needed to understand better before I made similar decisions in the future. Being wrong stopped being a verdict about my competence and started being a contribution to the ongoing refinement of the process. This shift had a concrete financial consequence. The second investor cut losses more cleanly than the first, not because the second investor was more willing to admit defeat, but because the second investor had separated the assessment of the investment from the assessment of themselves. When the investment evidence changed and the thesis was broken, the second investor could see it clearly and act on it clearly, because the question was not, am I a good investor? The question was, is this thesis still supported by the evidence? And that question has a much cleaner answer. The fifth and final transformation I want to describe today, was perhaps the most personal. It was learning that wealth is a byproduct, not a destination. The first investor in me had treated financial success as the primary measure of a life well invested, not in the sense of wanting to be rich for its own sake, but in the sense of using financial performance as the primary scoreboard by which I measured whether my work was meaningful and whether my judgment was sound and whether I was the kind of person I wanted to be. This created a relationship with investing that was heavier than it needed to be. Every loss carried existential weight that it did not deserve. Every gain produced a sense of validation that it also did not deserve. The scorecard of my self-worth was tied to the scorecard of the market, and the market is not a reliable assessor of human worth. It is not designed to be. It is designed to price assets. The second investor learned over many years to separate these two scorecards completely. The market's assessment of the current price of the positions I held was information about whether my thesis remained intact. It was not information about whether I was the kind of person I wanted to be. And this separation freed something that the first investor had never experienced. It freed the ability to think about investing with genuine curiosity rather than chronic anxiety. The second investor could look at a falling market and feel interested rather than threatened, could look at a rising market and feel analytical rather than validated, could hold through a difficult year and feel conviction rather than doubt. Not because the outcomes had improved, because the identity was no longer dependent on the outcomes. What the transformation actually requires. I have described 5 transformations separating controllable inputs from uncontrollable outcomes, moving from knowing principles to living them, building the discipline of saying, I do not know, learning to be wrong with equanimity, and separating self-worth from portfolio performance. None of these transformations came from information I already had. All the relevant information, none of them came from intelligence. The first investor in me was as intelligent as the second. They came from experience combined with honest reflection on that experience. And here is the practical implication of that. You can accelerate the transformation if you are willing to be honest earlier than the market forces you to be honest. The market will eventually teach you these lessons. It is a brutally thorough educator, and it does not allow students to avoid the curriculum. But the market teaches through loss. And the lessons learned through large losses are expensive tuition. The alternative is to examine your current beliefs about investing with the same rigor you would apply to any investment thesis. Ask where the beliefs came from. Ask whether the evidence supports them. Ask what would have to be true for them to be wrong, and ask honestly whether you are currently the first investor or the second, because the answer to that question determines not just what you should do with your money. It determines what you need to build in yourself before the money decisions will produce the outcomes you are working toward your assignment. Here is what I want you to do. I want you to write down the 3 beliefs about yourself and about investing that you carry most consistently into your financial decisions, not the beliefs you think you should have, the ones you actually have. When you are being completely honest, then apply the same analytical standard to those beliefs that you would apply to a business you were considering owning. Where is the evidence that supports this belief? Where is the evidence that contradicts it? What would have to happen for this belief to be wrong? And if I am honest about the evidence, is this belief helping me make better decisions? Or is it protecting a story I am telling about myself that the evidence does not fully support? This exercise will be uncomfortable. Genuine self-examination always is, but the investor who has examined and corrected their beliefs about themselves will make better decisions from every piece of financial education they consume, and the investor who has not done this work will take the best analytical framework in the world and run it through a set of unexamined beliefs that will distort every output. You cannot separate the investor from the investing. Build the second investor first, and then let the second investor build the portfolio. The bottom line, the investor, I was arrived on Wall Street in 1914 with skill and confidence and a set of beliefs about myself and about markets that were partially correct and dangerously incomplete. The investor I became was built through 5 specific transformations that the market delivered over decades, and the distance between those 2 investors is not measured in knowledge. It is measured in the honesty and the patience and the humility that the transformations required. You do not have to wait for the market to force these transformations on you. You can choose to pursue them. Examine your beliefs. Apply the same rigor to your assumptions about yourself that you apply to your assumptions about businesses. Build the process before you build the portfolio. And understand that the most important investment you will ever make is not in any stock or any fund or any asset class. It is in the quality of the investor. You are building yourself to become that investment, pays compound returns for the rest of your life, and no market crash can ever take it from you. That is how the intelligent investor thinks. Thank you.